In less than 48 hours, a market that prides itself on efficient pricing quietly handed over the steering wheel to something far more mechanical. 6 billion options contracts traded across one exchange network, and inside the S&P 500 options complex, 59% of the volume became 0 days to expiry. That's not a trend, that's a regime change. 3 million same-day SPX contracts changing hands every session. They said this could never happen. M, 1%, 1%, 7%, 88. That combination should make you pause. Big intraday whipsaws, a near flat close, and a volatility index that looks like a calm afternoon. The market was moving like it was scared, but pricing risk like it was bored. Here's the uncomfortable part. The institutions already understand why that happens. They understand it because they are the ones forced to react to it. They hedge it, they warehouse it, they price it. And most people only notice it after the move, when the story is already written. What I'm about to lay out doesn't require a conspiracy. It doesn't require a villain. It requires something more unsettling. A structure that can stabilize price temporarily, then release it when the stabilizer expires. And if that's true, then the manipulation window isn't some dramatic accusation. It's simply the period where short-dated positioning can press the market into a shape. And then, when that window closes, the market has to rediscover its real balance. Welcome to Signal Before Noise, where we read what the market is doing, not what the loudest headlines say it's doing. If you've been here a while, you know the rhythm. We look for the data that moves first, the flows that speak before the narrative catches up. If this kind of calm, pattern-based breakdown helps you connect dots, consider subscribing the way you'd keep a wise elder nearby. And tell me in the comments where you're watching from, because this market plays out differently depending on your time zone, your news cycle, and what opens while you sleep. Now let's rewind the tape and look at the event with forensic detail, because the details are where the contradiction lives. January 29th wasn't a classic crash day. There wasn't a single headline that explained every tick. Instead, it was a day of sharp swings, up, down, up again, while major indexes finished with modest moves. Microsoft fell about 10% after earnings, dragging software names. Meta jumped more than 10%, softening the hit, 5% on geopolitical tension, 23%, 83 billion shares. Put those together, and you get the texture of stress, heavy turnover, cross currents, big single stock shocks. Yet the index itself ended nearly pinned, as if an invisible hand was keeping the close tidy. And when people see a tidy close, they assume stability. The problem is that tidy closes can be manufactured by mechanics, not confidence. In the modern market, mechanics isn't a metaphor, it's a daily schedule. Contracts open, contracts expire, dealers hedge, systematic funds rebalance, volatility targeting strategies adjust. 3 million contracts per day, the center of gravity has shifted from weekly and monthly horizons to intraday deadlines. This is where it gets interesting, because the popular story says zero-day options are a chaos engine, whipping markets around through dealer gamma hedging. 2% of daily SPX liquidity at most. In plain English, the narrative and the data don't line up cleanly. So what's true? Are zero DTEs moving everything, or are they basically irrelevant? The answer is the kind people don't like. Both can be true, depending on the moment. A market can look stable most of the time and still be fragile in the tails. A lever can be small on average and still dominate at exactly the wrong time. Near key strikes, near key levels, near the end of the day, near the end of the month. That's the window. Not a permanent force, but a timed force. And the reason it matters right now is because January doesn't just end a week, it ends a month. It resets performance reporting. It reshuffles risk budgets. It pushes systematic strategies through their end-of-period procedures. The window closes, the reports print, and then February begins with a different set of incentives. Month end is where incentives quietly distort behavior. Large managers are judged on printed statements, not intraday truth. If an allocation committee meets on February 1st, what matters is the number on January 31st. That can encourage window dressing, where portfolios are nudged toward what looks good in hindsight and away from what looks risky on a report. It's not illegal. It's not even always intentional. It's a consequence of being measured at discrete moments. Now overlay that with a derivatives market that no longer sleeps, 4 million contracts per day. 9 million contracts daily, while VIX options averaged about 858,000 contracts a day. When you place that much hedging and speculation on a daily conveyor belt, the end of the month isn't a gentle fade out, it's a reset. The reset is the key. Positions that were comfortable in late January can become uncomfortable in early February because the incentive changes. Risk limits refresh, hedging rolls, volatility assumptions update. And the market goes from hold the line into the close to discover the next level faster than most people expect. That's why the phrase, "the manipulation window just closed," is useful as a description, not an accusation. It marks the moment when temporary supports from positioning, reporting incentives, and expiring leverage stop being guaranteed. What follows tends to feel like the market suddenly found a new personality, when really it just lost a set of constraints and breathed on its own. This is not new. In 1987, portfolio insurance strategies promised a smoother ride. The pitch was simple: sell futures as the market falls to control risk. It sounded rational, even responsible, but the structure created a feedback loop. Selling begat more selling. Liquidity evaporated at the exact moment it was needed. The result was not a normal drawdown, it was a discontinuity. In 1998, a different stress test revealed a similar truth. The LTCM crisis wasn't just a story about one fund being wrong. It was a story about crowded positions, leverage, and a system that had to unwind in a hurry once correlations broke. Markets didn't reprice gently. They snapped because everyone tried to pass through the same exit at once. In 2018, another mechanical promise took center stage: strategies and products that earned small gains by selling volatility, essentially collecting premiums in exchange for absorbing stress later. As long as volatility stayed low, it looked like free money. Then volatility spiked, the products had to rebalance, and the unwind happened fast. Again, not because investors suddenly became emotional, but because the structure was forced to adjust. In 2020, the world had a real shock, but the market's moves were amplified by positioning and convexity. Hedgers had to buy protection, dealers had to hedge, systematic funds had to de-risk. The price action was not just a reflection of news. It was the reflection of news interacting with leverage, margin, and forced flows. Different decades, different instruments, same playbook. When risk is concentrated into a rule, the market can appear orderly right up until the moment the rule forces everyone through a narrow door at the same time. Now, in 2025 and into early 2026, the rule is time. Same-day expiry, daily settlement, intraday cliffs. And it's not just about retail gamblers clicking buttons. The data suggests retail might be 50% to 60% of SPX 0DTE activity. But the impact of those trades depends on who takes the other side, how they hedge, and where the largest open interest sits. The real players in this story are the ones who cannot choose to ignore the flow. Dealers, liquidity providers, clearing firms, and the systematic strategies that react to volatility and correlation. Let's talk about the players, because this is where the market's quiet coordination shows up. Not through secret meetings, but through timing. First, you have the exchange ecosystem itself. 6 million SPX options contracts traded in 2025, and 0DTE became 59% of that volume. That's a behavioral shift the size of an earthquake, and it changes how liquidity is supplied. When maturities shrink, hedging becomes more frequent. When hedging becomes more frequent, the market's microstructure becomes more important than its macro story. Then you have market makers and dealers. They are paid to quote two-sided markets. They are paid to absorb flow, and they are paid to manage risk. When the public buys calls, sells puts, buys spreads, sells spreads, dealers are on the other side. Even if net gamma hedging is small on average, the intraday adjustments can be sharp around specific strikes and levels. Think of it like a ship. Most of the time, tiny rudder adjustments keep it steady, but near a narrow channel, those adjustments become decisive. Next are clearinghouses and prime brokers, the plumbing that most people never think about until it matters. When volatility rises or liquidity thins, margin requirements can change. Haircuts can widen. Financing can tighten. These aren't opinions, they're risk controls. And when risk controls tighten, leverage is forced to come out. Then there are systematic strategies: volatility targeting funds, risk parity, trend followers, and strategies that must rebalance based on realized volatility or drawdowns. They don't feel anything, they measure. And if realized volatility spikes, like it did intraday on January 29th, these strategies can reduce exposure into weakness or into noise, depending on their rules. That creates flows that look like sentiment, but are actually math. Finally, there are the institutions that care about the close. Asset managers reporting month-end numbers, funds measured against benchmarks, and anyone whose performance is judged in discrete periods. When those incentives align with mechanical pinning forces from options expiration, you can get an end-of-day tape that looks strangely controlled. Sometimes it is the market being guided into the least painful settlement for the largest amount of positioning. Not forever, not every day, but often enough to matter. So where's the dislocation? It's between what the market is doing and what the market is pricing. On January 29th, the market behaved as if risk was elevated. You saw sharp swings, 36 billion shares. You saw major single stock shocks. You saw oil jump. You saw yields move. In behavior terms, that's stress. 88 says something else. It says implied volatility is contained. It says the price of insurance is not screaming. Both cannot be true indefinitely. Either the market's behavior calms down to match low implied volatility, or implied volatility rises to match the market's behavior. That tension is the dislocation. Two data streams telling opposite stories. Now bring in the options regime. If 0DTE is 59% of SPX options volume, then a lot of today's risk is literally expiring today. That creates a strange illusion. Risk can feel intense intraday but vanish into expiration. That can compress implied volatility, even as realized volatility spikes. It's a kind of daily amnesia, and that amnesia is exactly why the manipulation window matters. When the dominant leverage expires at the close, the market can spend the day oscillating, only to snap into a settlement zone as the clock runs out. Then, once the contracts are gone, the scaffolding disappears. The next day starts fresh, the next month starts fresh, and the market is forced to reprice without yesterday's positioning support. And here's the mechanism in plain language, without mysticism. Imagine a crowded theater with hundreds of doors. People can drift in and out calmly. Now imagine the same crowd is told there are only 2 doors, and everyone must exit within the last 3 minutes. The crowd's behavior changes, not because the people became different, but because the timetable and the bottleneck became different. That's what short-dated options do to market microstructure. They compress a huge amount of risk transfer into a narrow window. A same-day option is like an hourglass. Early in the session, a small move in the index may not change the option's sensitivity much. Late in the session, with the strike near the money, sensitivity can flip rapidly. That's the famous gamma effect people talk about, but gamma is only part of the story. Time decay accelerates. The option's delta can jump with tiny price changes. And even if many traders are using defined risk spreads, someone still has to intermediate the pieces of that exposure. The dealer might be long one strike and short another, or short a vertical spread that behaves differently as time collapses. That creates hedging that is less about directional bets and more about staying neutral while the ground is moving. This is where pinning comes from. If a massive amount of open interest sits around a particular strike, the hedging flows can become self-reinforcing near that level late in the day. When price drifts above the strike, certain hedges push one way. When price drifts below, hedges push the other way. The result can look like gravity. Price wiggles, but it keeps getting pulled back toward a zone that minimizes the pain for the greatest amount of exposure. That doesn't mean anyone chose the close. It means the structure created a magnet, and participants responded to the magnet because they had to. There's another layer. Dealers and liquidity providers care about inventory risk, and inventory risk is measured at the close. A position that must be managed for 5 more minutes is a different animal than a position that must be managed for 5 more days. When 0DTE is 59% of SPX options volume, that end-of-day inventory calculus becomes a daily ritual. Add month-end reporting on top of that, and the incentive to avoid ugly prints becomes stronger. A tidy close helps many balance sheets breathe. A messy close can trigger risk controls, force rehedging, or create awkward statements that clients will read. Again, not a conspiracy, just incentives stacked on top of mechanics. So when people say the market was manipulated into the close, the more accurate statement is usually this: the market was engineered to have a close, and a lot of modern exposure is engineered around that close. The closer you get to the deadline, the more the deadline shapes behavior. Now, think back to January 29th, 7%, 78. Under the hood, one mega cap dropped roughly 10%, and another surged over 10% in the same session. That is violent redistribution of risk, while the index print remains strangely polite. A polite print is not always peace. Sometimes it's pressure being held in place by timing. And timing, by definition, expires. Let me show you the evidence, because once you anchor it in numbers, it stops sounding like a vibe. Start with scale. It's a continual churn of leverage and hedging obligations. 6 million contracts. That's an entire universe of exposure concentrated into one index. 3 million contracts per day. Now combine that with the claim that more than 95% of 0DTE volume is defined risk strategies. It means the loss is capped for the trader. The hedging still exists. The flows still exist. The positioning still exists. Defined risk structures can still create concentrated open interest at specific strikes that matter at the close. Then look at participation. If retail is roughly 50% to 60% of SPX 0DTE, that tells you something about motive. Retail tends to trade short-dated options for immediacy, for leverage, for short windows. Institutions tend to use options for hedging, for overlays, for structured exposures, and for liquidity provision. And when those motives collide on the same contracts, you get a market that can look like a tug of war. Now layer in the day itself. Saw 1, 88, 36 billion shares traded. Those are not poetic numbers. They're the signature of a market that is busy, volatile in action, and calm in pricing. So what does this mean going forward, especially now that the calendar has flipped and the end-of-month incentives have reset? Historically, When markets lean on mechanical stabilization, the release tends to show up in one of three ways. The conservative scenario is a slow repricing. Realized volatility stays elevated, implied volatility inches up, and the market stops getting those neat, pinned closes. The index begins to drift more openly because the expiration scaffolding is not enough to hold it. The moderate scenario is a volatility event that doesn't look dramatic at first. The market gaps down, recovers, gaps again, and the VIX finally responds. The key feature is not the size of the move, but the change in character. Fewer rescues, into the close, more persistent trend days. The aggressive scenario is a forced unwind. It usually begins with something that seems unrelated. An earnings shock in a mega cap, a sudden move in rates, a sharp move in oil, followed by risk controls tightening. Margin goes up. Liquidity thins. Systematic strategies de-risk. Options hedging becomes one-sided. And the market discovers that a lot of calm was borrowed from time, not earned by fundamentals. Notice what's missing. There is no need to claim a guaranteed outcome. The point is the setup. The point is that a dislocation exists, and historically, dislocations resolve. So what should be watched? If you want to know whether the window is truly closed and the market is repricing, watch the relationship between intraday swings and the closing print. If the market keeps whipping around but closing neatly near key levels, the expiration mechanics are still dominant. If the market starts closing away from those magnets, the mechanics are losing control. Watch implied volatility versus realized volatility. When realized volatility rises and implied volatility refuses to follow, insurance is cheap relative to movement. That gap can persist for a while, but it is not stable forever. If volume stays elevated while indexes look calm, it often signals heavy repositioning under the surface. And watch the distribution of moves across sectors and megacaps. When a few names can swing 10% in a day and the index still looks composed, it tells you diversification is thinner than it appears. This brings us to the divide, and it's not about intelligence, it's about attention. Most people experience markets as stories. They hear earnings, the Fed, geopolitics, and they assume price is simply the story expressed in numbers. But structure matters, liquidity matters, expiration matters. The market is not just opinions, it is plumbing. Those who understand the plumbing don't have to be right about every headline. They just need to recognize when the market's behavior is being shaped by temporary forces. They recognize that institutions move first, because institutions must manage risk first. Retail moves last, because retail is reacting to what already happened. And that information gap becomes a wealth gap over time. When 59% of SPX options volume expires the same day, the market is living on short clocks. It can look calm, then turn sharp. It can look chaotic, then print a tidy close. And it can do that repeatedly until the day the scaffolding fails to hold. The manipulation window just closed. Not because someone flipped a secret switch, but because time moved forward, reports were printed, and positioning rolled. What comes next is not a prophecy, it's a process. The market either continues to be held together by short-dated mechanics, or it starts to reprice in a way that makes the earlier calm look like an illusion. This is signal before noise, where we decode what matters before it becomes a headline. If this connected dots you hadn't seen, you know what to do. And the real question isn't whether the structure will show itself. The question is whether you'll recognize it before the crowd is forced to.